All right, here we go. Spring market update as of late April. And man, been a bit of a roller coaster, hasn't it? I've got a lot mapped out for you over the next roughly 45 minutes to an hour. As I mentioned, I'm going to do my best to leave some time for some Q&A at the end. Most of you who are here with us live have been through these types of things before. I was told, as a side note, by my 8-year-old, I should say the following: if you're watching the recording of this on any of our social media platforms, and he told me, this is a direct quote, he said, tell them if they like puppies, kitties, or ice cream, they should like, follow, or subscribe. Because apparently that's what all the YouTube content creators for 8-year-olds say. So if you like puppies, kitties, or ice cream, you should like, follow, or subscribe. Otherwise, you're here live and excited for the spring 2026 market update. Let's dive right in. First, what we're going to cover today, really 3 parts. Number one, where we are right now, which most of you know, but my goal here is to maybe arm you with some additional data that you could use with your teams and or with your buyers or sellers. Number 2 is a revisit of our ongoing thesis of the relationship of buyer demand versus seller supply, but continuing to build on that both for this last like 30 days or so of the spring market. And then that naturally leads into number 3, predictions for the back half of the year. If you've been with me live, or some of you, excuse me, who are watching this are coaching clients, so we've talked about this quite a bit, really going all the way back to like November of 2024. I've not been as bullish on the broader market as many. Maybe just a little bit of a spoiler here. That thread is going to continue here. That doesn't mean that you can't go be really successful. And we have some advice, suggestions, coaching on how you might be able to do that. But I will continue with my somewhat bearish, somewhat contrarian view, because statistically over the past 18 months, I've been right a lot more than I've been wrong. So let's hope that that trend continues. But that's part 3, what comes next in back half of the year, and some structural investments I'd like for you to think about making for 2027 and beyond. It's a lot of ground to cover, so buckle up. Here we go. Here's where we are right now. I pulled forward some prior predictions, not as like a I told you so type thing, but just to anchor a few points. For those of you who were with us at the live event that we did in Raleigh in November of 24, or joined us at like that year-end business planning forecast into 2025, my stance has been and continues to be that rates are going to stay higher for longer than most people think, that inflation is stickier than most people think. That has held true. I have more maybe color commentary for you as we continue to move along, but my stance is still higher for longer. The other we talked about often that I will remind you of, because we're in this window right now, is that volatility creates opportunity. Very specifically, this recent rate dip that we've seen often causes a little rush of buyers, often causes a little bit of a price spike in some markets. So we want to be mindful of that. And number 3, as you always know, the market does not determine your success. It points us directionally how we could be successful. I was just a few weeks ago together with our board of advisors members, our quarterly mastermind group of coaching clients who run medium to large teams. Some of you are on the call here right now. Many of those people and many of our other clients have just come off their best Q1 ever. A number of our clients had their best year ever in 2025. So it is possible to both have broader market headwinds and to also be building into your best quarters, halves, years ever. Those predictions have held true, and I think they will continue to be true moving forward. Here's the kind of what's happened. You've had a front row seat to this, so I don't really want to belabor this. When we were together for my 5 ways to kickstart 2026 webinar that we did in early January, I had said to you that I felt like rates were near 3-year lows and that the market was positioned for the busiest spring in 5 years. That turned out to be true. All of your businesses were building. Many of you benefited from that. Some of you still are, but from a broader market standpoint, statistically, that was accurate. And then, we decided to go start a war in the Middle East. And that created this shock, and you saw mortgage interest rates up 50 basis points in 30 days. The drag that created per NAR was existing home sales fell to a 9-month low. back below that 4 million annualized number, which is a really, really low number per NAR. Basically, it sent a big group of buyers to the sidelines. Not all buyers, but a big group of buyers. That was what you felt until we have this fragile ceasefire over the past couple of weeks, currently holding-ish. We're not going to get into geopolitics here. That's a whole nother discussion for offline. But that sent your 30-year fixed rate down to roughly 6.25. I've got some rate graphs for you later. But we went from 6.5, 6.6, 6.7, as my kids would like to say, and have pushed it back down to roughly 6.25. That's been your spring, and you felt it. And you felt it in listing inventory. You felt it in buyer whiplash. You felt it in buyer pickiness. So I don't need to over-explain that to you. You guys are the pros, but that's the backdrop that we're working against. Here's some stats for you. I'll send you the slide decks, or if you're watching this as a recording, link to it so you have it as well. I've also created for you a supplemental sheet that's citations for where I pulled all of this stuff from. I have a QR code or a link for you at the end of the presentation on that as well. 30-year fixed below 6.25. Here's some promising weekly data as of the week that ended April 17th, which is the most recent data I had access to when I built this. Mortgage applications, which, as you know, is a leading indicator of buyer activity. That was up roughly 8% the week ending April 17, which would be compared to the week ending April 10. Purchase applications, which is, so this is year over year data. That would be the most recent period of 26 compared to the most recent period of 25. That's up 14%. That's a good leading indicator about how this spring market is shaping up compared to last spring market. And then finally, a little more data nerdiness for you here. Pending home sales month over month. This is NAR data from March. We obviously don't have data from April yet. But pending home sales in March of 26 were up 1.5% from March of 25. And that beat a consensus of 0.5%. So let's keep moving. I want to talk about this dip in rates so that you don't look at it as something structurally that's likely to happen, and instead it's more of a head fake. I look at this as risk premium unwind. Said a slightly different way, the bond market had priced in all the risk from geopolitical tensions in the Middle East, Strait of Hormuz, supply chain disruption kind of stuff that you've read about in the news. Among many other things, priced that in, drove bond rates up, that pulled mortgage interest rates up. The ceasefire, however fragile it may be, has caused a little bit of an unwind of that risk premium or heightened bond rates, and you've seen mortgage interest rates come down. But what you've also seen over the past year and a half to 2 years is this whiplash based on geopolitical risk, based on tariff risk, based on you name it. So when the market gets spooked, bond rates go up, mortgage interest rates go up. When the market calms down, bond rates come down, mortgage interest rates come down. The Fed largely reacts as a lag to that based on inflation data and based on employment data. We're not going to dissect all of that today, mostly because it's probably a little too nerdy for this conversation, but would also eat up some time. The bumper sticker here, though, is that we don't see anything that creates structural downward pressure on mortgage interest rates, certainly not in the near term. It is possible, I suppose I should give you this caveat because it's not in the slide deck, and I get this question a lot. It's like, okay, well, what about the Fed chair and the new Fed chair and Trump administration policy and all this stuff? I do think it's possible to quite likely, and this is not a political statement because both parties are guilty of this in election years. I think it's possible to quite likely that you see some financial finagling, whatever that might be, that could cause some relief in mortgage interest rates as we get close to the midterm, that could cause some relief in gas prices as we get close to the midterm. If you see that, take advantage of it, particularly for your buyers or for yourselves personally. But don't confuse that with a structural change in monetary policy. I think it would just be, let's call it political finagling and leave it at that. Okay, here's some data that I think is interesting. Again, I linked to all of this for you. This is about pressure in different markets. 38 of the 49 largest markets in the U.S. are now buyers markets. This is based on some Redfin data. That's up from 29 markets a year ago. Sellers outnumber buyers nationally by 43%. That's a Redfin number as well. I put a little caveat in this because a number like this, candidly, sort of, it irks the math nerd in me. I want to ask, like, okay, so how do you actually know how many buyers there are in the market? And the short answer is that they don't. They use a model that I explain in the resources that I link out to that sort of guesstimates at best the number of buyers. But whether we want to get into the specific, is it 43% or something? I think the headline is still true. And that is that seller inventory continues to grow relative to buyer demand, which puts downward pressure on prices. Strongest buyers markets per this report here on the screen: Miami, Nashville, Austin, San Antonio, Las Vegas. As you'll recall, all of those were COVID era boom towns and maybe got out over their skis quite a bit. And that seems to be what's happening there. But this is helpful to know and perhaps helpful to include in your listing presentations when you're trying to tell the seller the story of your house ain't worth quite as much as you think it is. I have said to our coaching clients and to our board members a few weeks ago, and this continues to be true, I think your number one goal as a real estate salesperson right now is to sell everything you can possibly sell now through the end of May, while we are still technically in this spring market. I think when we get into kind of the dog days of summer, we get closer to the midterms, I think things become more tumultuous. I think things become less certain, and broader market headwinds sort of persist. But I got a few points for you here. Most of these are pretty common sense, but I really want to drive them home. The first is for your sellers. We've got to be on the market, not trying to get to the market. We have to be properly priced. I would even argue aggressively priced. More on that in just a second. For when the dip happens. Now, the dip I'm talking about here are temporary dips in interest rates as broader uncertainties resolve either temporarily or permanently. So you're in this 3-week run here where you see downward pressure on mortgage interest rates, new applications are up, et cetera. We just talked about that. But it's in that window that if your sellers are positioned properly, you have the chance to get more deals. If your buyers are ready to act quickly, you have the chance to get more deals. But if they're not, then we run the risk of missing this spring seasonality window that we're in. I wrote a pretty lengthy blog post recently. This QR code on your screen will take you there. Don't do it now. Just come back to it later, please. And I put it in the resources as well. But about pricing today. But here's the headline for you that I think you instinctively already know is if you're pricing based on sold comps right now, then you're out of the market already. In most markets, you're overpriced by doing that. If you're pricing relative to active comps, following our like bottom third of price, top third of condition, or maybe even like bottom 20% of price and top 20% of condition, I think you're getting much closer to the number. What I've seen, and this is just anecdotal evidence right now, but what I've seen over the past few weeks is you're probably looking at a 3 to 5% discount to what your active comps value number tells you is the price where you're probably going to land. Now, caveat would be some of you are in very hot markets. This is very niche. But if you were like a 10 out of 10 in location and a 10 out of 10 in condition, and you were priced at or a smidge below what the active comp math would tell you, you're still getting multiple offers right now. But if we're speaking just sort of broadly what the recipe is that's working best, it is active comp positioning, 3 to 5% below market value is what gets offers, not just the head fake that comes from showings from lukewarm buyers that never turn into anything. I did feel it was important, and you can read way more about that QR code blog at middletonelitecoaching.com. I wrote like a 5-page essay on it. Good luck. Number 3, hidden cost of waiting. In prior conversations, we've talked about, okay, well, if the buyer waits to buy and they're waiting on rates to come down as prices continue to go up, that math don't math. But what you've also seen now recently is in the vast majority of markets, and this is the national trend as well, is you've seen prices are basically flat. So looking at this little headline here, national prices up less than 1% year over year. 89 of the top 300 markets in the country posted year over year price declines. So that appreciation backstop that supports the hidden cost of waiting is now gone. Fortunately, in most of the markets of those of you who are here live, that price trend hasn't reversed, but it has certainly flattened. And then the fourth piece, and I'll speak more about this a little bit later in part two, but the increase in concessions, this is helpful for your sellers to know as well. The headline data came from a report that was a year ago, but you know instinctively that this has continued to increase. This number is pushing probably 50% or more, I would guess, of real estate transactions right now include seller concessions. That does not take into account how buyers agents are getting paid and treating that as a concession. So that is a footnote. So these are things like seller paid repairs, or they're throwing in furniture or appliances or home warranties or things of that sort. Okay, so action item number one, just so those of you who are taking notes here, is sell everything you can sell now through the end of May. Fish while they're biting, make hay while the sun shines, whatever it is that you want to say. Go run like your butt's on fire between now and the end of May. If you need more seller strategy specifics, see the blog post. Wanted to update you on a few things that I think are interesting. We're still in like broader market conditions right now before we get into the tactical weeds here. The percentage of mortgages that are locked below meaningful mortgage interest rates, 70% roughly of mortgages still are fixed below rates of 5%. That's as of Q3 of last year. I can't imagine that number's changed significantly. But here's kind of an interesting piece that I dug up for us. Mortgages locked above 6% have surpassed mortgages below 3% for the first time in 5 years. I'll just sit with that for just a second. Here's kind of what that tells you is those people who locked in the immediate post-COVID, historically super low interest rates that we'll probably never see again in our lifetime. The percentage of people that have that is now smaller than the percentage of people who have 6+. That just tells you what you've sort of instinctively felt, is that people were moving on with their lives anyway, in spite of this. That, as I put in the notes here, that life events are starting to override the extra cost associated with their monthly payments. That would be a signal that if you've drifted a little bit from the people in your database who bought from you or refinanced in any period from like, let's call it summer of 2020 to like Q1 of 2022, when we saw rates start to rise, roughly that like 18 to 20 month period, everybody that you know who did something, bought or refinanced in that window of time, is now statistically even more of a candidate to do something and move on with their lives. So maybe there's a footnote to database communication in that stat for you. Broader market setup. This is an update on, you'll recall we've talked about this for as long as you've known me, the things that drive buyer demand and the things that drive seller supply. So let's talk about buyer demand. Number one, net migration. Shout out to those of us in South Carolina, led the nation 2025 in per capita net migration. Midwest trends are noted here, and top inbound metro areas for Q1 of 2026. There are a lot of you on this call live from these cities. This is a blend, by the way, of a handful of different migration reports, all of which I'd link to in the resources for this. You have done this before, but I want to encourage you to continue to do this. If you live in a high net inbound area and you don't have a strategy for capturing out-of-town buyers, you're missing one of the biggest trends in real estate right now. And it's also one of the trends that is, how might I word this? Even if the market gets worse, which I'm not necessarily predicting, but you have to think this way too, in my opinion. Even if the market gets worse, I believe that people are still going to migrate to the Carolinas. I believe that people are still going to migrate to a lot of, sorry, I got ahead of us, a lot of these cities that we're talking about down here. So if you don't have an inbound buyer relocation strategy, you're behind. So time to get caught up on that, and we can help you if you need it. Part number 2 of buyer demand, demographic waves. You know this, but these data I think are really important. It's mostly all boomer related, and it has been for a while, and it's going to continue. The boomer seller trend over the next 5 to 10 years is the biggest structural change in real estate that you're going to see outside of AI, which we'll talk about later today. But here are the data from a few different sources. NAR's profile of buyers and sellers was one of the big sources for this. 53% of all sold transactions, this is 2025 data, 53% of all sellers were boomers. 42% of all buyers were boomers. And over the next decade, it is estimated, this was a wealth firm report that I read, 4 to 5 trillion, that is trillion with a T, $4 to $5 trillion, this is a global number, $4 to $5 trillion of global wealth will pass from that boomer generation to their adult heirs. About 50% of that, plus or minus, is going to be in the US. So let's call that $2 to $2.5 trillion worth of wealth of all forms will pass from one generation to the other. Some of you are already working strategies on this where you're working the boomer angle, or you're working the adult children of the boomer and the estate planning, retirement, downsizing angle. If you're not already doing that, you're missing a huge trend. If you are doing that, like double and triple down on it. I put on your screen, but for the sake of time, we won't go through all of them. What I created was 7 high net worth opportunities / boomer plays. I think all of these are really big opportunities over the next few years that are not market dependent. They are broader trend dependent, and the trend is in your favor. So maybe you and your team go back and look at these stats. You look at these 7 opportunities. Don't go chase them all, but decide like, hey, maybe what's one additional thing we're going to add to the stack as we get into the summer and the back half of the year. The third thing that drives buyer demand is monetary policy. This is the one that everybody's been talking about really for almost 5 years now. Let's call it 4 years, plus or minus. I said earlier, risk premium unwind, not a Fed pivot or a monetary policy pivot. As of data that I pulled earlier this week, these are the year-end projections for the 30-year fixed for all of these people. Yun is Dr. Lawrence Yun, the chief economist for NAR. 5.7 on the low end, 6.4 on the high end from the Mortgage Bankers Association. The National Association of Home Builders is a little more vague, just below 6, but conditional on Iran de-escalation was their comment. Yeah, bumper sticker here, we're at 6.25. Best case, most optimistic, we go to 5.7. As we saw just ever so briefly in Q1 of this year, something with a 5 handle in front of it looks really good and is psychologically important. But mathematically, this just basically says like no projected change in rates. I think you should just like hit every buyer in the face with this slide. And if they still want to argue with you about rates or waiting, then you should refer them to an agent in your market that you don't like. Here it is in a graph. Don't actually do that, by the way. I mean, if you do, text me privately. 2022, this was when rates started going up. I think you should put this in every buyer presentation that you do as well. So I would put this, oh, not that slide. We're going to that one. I would put this slide. Here's where we're going. I would put this slide. Here's where we've been over the past 4 years. You will note, here's where we were as we headed into the early spring market. And then we started dropping bombs in the Middle East, and that pushed rates up. And then that has fragilely de-escalated and has crept back down. But you could go all the way back to early 2023, and you could find 1, 2, 3 periods since early 2023. So let's call it 3 times in 3 years that mortgage interest rates have been at this level or very close to it. that should be compelling for buyer activity. I recognize buyers are being really picky right now, but I think there is some under messaging around how good this opportunity is for buyers, because you also know that inventory is significantly higher in most of your markets now than it was back here, and certainly higher than it was back in this run in late 2022. So buyers have more choice, and mortgage interest rates are hovering near a 3-year low. Let's go over to seller supply. So those are your three things driving buyer demands with some updates. Seller supply, things driving resale inventory. Most of this is refresher, so I won't belabor it. Some of it's a little like cliche coaching information, but still relevant. Boomer sellers, I mentioned it already. I'll keep talking about it for at least the next 5 to 10 years. But strategies around aging in place or downsizing, estate sales, inheritance and wealth transfer. And then this job relocation note is actually not related to boomers. So that's a typo error on my part. But that is a thing that is driving a little bit of seller supply. I would also maybe layer underneath job relocation. Pay close attention to layoffs. Corporate layoffs are very popular right now. Shareholders, or let me rephrase, the stock market really seems to be rewarding publicly traded companies who are cutting staff and driving that profit to the bottom line. Some of that is like short-term cash positioning for these companies, and they're trying to reward themselves and their stock prices. I don't know that I necessarily agree with that, but they didn't ask me. The other that is a long-term trend that I think is getting maybe not as much news as it should is the displacement of workers that will be caused as more AI is integrated into businesses. I have more briefly for you on that at the end of this, and it will be a topic of next month's webinar. I think there's going to be more downward pressure on employment than most people expect from AI integration into businesses. It's happening at the larger level right now. And for those of you, particularly in like big tech markets, you might get pushed on this a little bit more, or in manufacturing markets where automation continues to increase as robots become more popular. I think that puts downward pressure. That's a little farther out, but I do want you to be aware of both of those things. And then the classic that you've heard from 1,000 other people just like me is the old 5Ds, diamonds, people getting engaged. They want to move out of mom and dad's house or out of their apartment and buy a house. Diapers, they have a baby or another one, and they need more room. Diplomas, kids leaving, going off to school, empty nesters, selling the family home, divorces, statistically 50% of all relationships, no judgment, it happens. Big opportunity because that creates a real estate need. And then downsizing or death, which kind of ties back to your boomer seller. I don't know that you need to be playing in all 5 of these, but I think naturally within your databases, you have these events going on. Brief little rabbit trail here. This actually came up on a coaching call this morning. I think that my observation has been that most real estate agents think they do a good job of staying in touch with their database. And maybe they do, but I would encourage you to really look closely at how well do I do that? Let me be real specific here. Here would be an exercise you could take back to your office or back to your teams. Base level here, build it however you want to. But I would say you and every person on your team would clearly define the top 100 people in your database. 100 is an arbitrary number. Make it 50, make it 250. I don't care, but you pick a number. Let's call it top 100. You would be clear about who those top 100 are. You would be clear about what the next real estate decision that person is going to make. Are they going to buy? Are they going to sell? Are they going to invest? What's their next likely real estate move? What are the motivating factors behind that next real estate move? And then maybe in parallel with the motivating factor, it would be what would be the catalyst of that next move? Okay, so who are they? What would be their next move? What would be the motivating factor, and or what would be the catalyst of that? If you knew that about the top 100 in your database, and you were really crisp about it, if your team members knew it about their top 50 or top 100 and were really crisp about it, I would propose to you that you're probably doing a really good job of staying in touch with that group of your database, and you're not going to miss opportunity. I think people are missing opportunities that are within their database because maybe they're relying a little bit too much on marketing. And marketing has a role, please don't misunderstand, but they're relying a little bit too much on marketing to have it sort of cover their database. And might need to step back into like structurally one-on-one, making sure that we have purposeful conversations. I think when you do that, if you're not already, many of you are doing very good at this, but if you're not, and this hits home for you, you'll naturally start to uncover stuff in these 5 Ds. Over the river and through the woods to go, I say, I think you're probably missing opportunity within your database while you're looking at other things. The other thing that impacts seller supply is new construction, as you know that. A lot going on here. Builders are super, super motivated to sell. When they saw rates spike headed into the spring market, they're smart. We could agree or disagree on how well they build houses, but they're smart enough to know from an incentive standpoint what needs to happen. Here's some numbers for you. 65% of builders offered incentives as of these data sources in February of 2026. 11th straight month above 60%. Lennar's incentives averaged 14%. Pulte's averaged 11%. Horton's rate buy downs are 1 to 1.5 below market. Beezer's got a 4.99 program. Actually, a number of people have programs that are pushing it below 5. Here's an interesting stat at the bottom of this slide. New home premium over existing homes. Said a slightly different way, how much more are people willing to pay for a new home, or how much more is a builder going to sell a new home for compared to resale inventory? That premium was only 7.8%. Historically, that number is like 10 to 15% more. In summary, new homes typically sell for 10 to 15% more than their resale comps. Only 7.8% above tells you even more about how builders are getting aggressive and or buyers aren't willing to pay quite as much overall. And I'm sure you're all doing this, but if you're listing homes that are highly competitive with new construction, I think we have to be really, really, really clear on what our resale seller is going to have to do to compete with new construction down the street. If you're working with buyers in your market, or you're trying to figure out a way to get buyers off the fence, the more that you know about new construction incentives become little like pieces of bait that you could dangle in front of that unresponsive buyer. Maybe some more ideas to knock people off the ledge. Okay, so there's your backdrop. There's maybe some updates on those things and some thoughts about starting to implement, but let's get into part 3 here, what comes next. And these are predictions for the back half, and then looking out into 2027, which it may seem a little early to do that, but I'm always really striving to think 18 to 24 months ahead. Some of this I've mentioned in different ways already, but let me summarize it for you. Point number 1 is I think we've seen the lowest rates. We're going to see, we could argue that maybe you'll get a little bit lower into the 6s. Maybe you'll get into the high 5s, but it's doubtful. Those rate dips that we get, they're going to be event driven. They're not going to be structural. That's still my base case. I think it's actually possible, not to throw even more of a wet blanket on the whole thing. I think it's actually possible that you see mortgage interest rates continue to move up. Some of that is tariff related. Some of that is supply chain lag for Middle East events related. Some of that is, and this is not a political statement, although it'll sound like it, but both political parties have decided just to continue to spend however much money they want to spend, and continue to take on debt to do that. And U.S. debt doesn't seem to be as enticing to other countries. Go figure. And that puts upward pressure on all sorts of things, particularly bonds, which impact mortgage interest rates. So I could see a world in the not too distant future where we're just hanging out in the 6s, and we think low 6 is awesome. And we see times where we're back in the 7s, which, you may recall we've been there over the past couple of years. Not a popular opinion, but we'll see if it holds. That's why we record these things and we track the forecast. I think this is almost a certainty. The closer we get to November, the messier it gets. My personal opinion is that the midterm election will be the most contentious one of our lifetime. I think people are already making decisions consistent with that, particularly high net worth people. But I think you'll see people, you've heard the phrase before that overwhelm will cause people to stall. I think that's where like volatility in markets, uncertainty, et cetera, shows up. So if I were to like really simply give you what I think is going to happen / we should do, it is between now and the end of the end of May, sell as many houses as you can. Over the summer, as we get into like seasonality is no longer our friend, I think you have to be super purposeful on uncovering motivated buyers and sellers, because I don't think the market's going to do you any favors. Simultaneously, I think you need to be building infrastructure that pays off in the back half of 26 and into 27. More on that in just a second. As we get closer and closer to the midterms in November, and I think this, we probably start to feel this like when we come back from Labor Day, all bets are off. And I think the people who are going to buy and sell in the window between Labor Day and the midterm election are only going to be those people who must sell. I think it's unlikely, anything's possible, but I think it's unlikely that you're going to see a seller who's like, yeah, I think I kind of want to sell. Maybe we'll give it a shot. I think it's unlikely you'll see them get aggressive enough about pricing to actually do it. I think it's unlikely that you have a buyer who's like, yeah, we'd really like to move to your area, and if the right house came along, we probably would buy. I think it's unlikely that there's going to be enough like external pressure to convict them to make a decision. I'm not saying houses won't sell. They will. I think it will be harder to do, particularly in that window between Labor Day and let's call it like mid-November. And then without regard to the way the midterm elections land, markets really like certainty. And if we're able to get some certainty in either direction on the other side of the midterm, then that sort of frees us up to catch our breath at the end of 26. Hopefully, we've had some resolution to geopolitical policy and trade policy. That is a wish. Hope it's not a strategy, but hopefully it works out. And then that sets us up for maybe a reload in the spring market of 2027 that I had hoped we were going to get in the spring of 2026. That's just one guy's opinion. And if you follow that whole flow, then the way I'd want you thinking about your business over the next 12 months is that there are actually these different dynamics of markets that aren't just seasonality based, that are broader event and broader market driven, that are going to determine how we need to go find buyers and sellers. I'm not saying this to scare you. I'm saying this to prepare you. Oh, look at that. I didn't even mean to do that. I think you're going to have to be ready to bust your butt. And I think your team members are going to have to be ready to bust their butts. And your advantage, otherwise you wouldn't be here with me, is your ability to understand all of this and to explain it to your buyers and sellers simply, to cut through the noise, to cause them to make the best decisions for them. So that's my stance. The two scenarios parallel sort of pairs that. The bear is rates get stuck above 6.25. Units move along sideways. Bull case is resolution of things, rates move below 6. We get a good shot in the arm on buyer demand. Maybe you need more room in your org chart, or you need some more sales help or in your pipelines to take care of that. Take a deep breath here with me for just a second. And I just want to reiterate one thing that's super important. If you've been with me on this, 40 minutes into it right now, I wouldn't fault you if you thought, Bill's giving a little bit of a doom and gloom or scare approach to this. Also know that my goal is to prepare you for what may happen. And if you're prepared for that and it doesn't happen, you're just going to gain even more market share if we get really positive reactions from the market. I think the other goal I have in this is to remind you that the broader market could be melting down around you, which is not my call, but it could. And you could still be wildly successful. And some of the things that I've already mentioned to you today could cause you to do that in spite of broader market conditions. So I hope that does emerge through the general sort of like realistic bordering negative tone of my approach today. A couple more things for you, then I'm going to open it up for some Q&A because we're right on time. 3 structural investments for 2027 and beyond. So these are things that I would coach you to be working on right now, some of which I've already mentioned, that probably won't pay off in any meaningful way until the back half of the year or into 2027. Some of you are already doing these things, in which case I would just encourage you to like double and triple down on them. Some of you might have been reminded that you need to get back to some things like your database with purpose, or you've been delaying some things like digital marketing related ideas. You've been talking about maybe doing some Instagram stuff, or you've been talking about maybe doing some YouTube stuff, or you've been thinking about working on some Google stuff, or you've been thinking about the role that AI search plays in finding your content online. Like all of those are super relevant right now. We're not going to talk about any of them in detail today. But I'd really like for you to think about your business through the lens of like, I don't know, here might be the question. By the end of the year 2027, if I were running my database at a level 10 out of 10, what would that look like? And what would I need to do between now and then to get to that point? It's a very simple question, but it's one to sit with and think about. The same for digital marketing. You'd say by the end of the year 2027, or I might encourage you on this one to look at it as by the end of the year 2026, if I were doing digital marketing at a level 10 out of 10, which is going to be relative to you. It's not to say go do everything. If I were doing it at a level 10 out of 10, what would that look like? What would I need to do between now and then? And then you'd create that plan with your team. And if you have the internal leverage to be able to start working on it now, awesome. But if you feel like those plans would pull you away from selling as many houses as you can between now and the end of May, I just want you to have the strategy sitting on the sidelines so that when we get clear of the Memorial Day weekend or wherever we think the spring market ultimately stops, if it does, which I think it will, now you've got the plan to go over the summer. Our dual track is we're going to lead gen and market for the new now business, and we're going to build this, in this case, digital marketing infrastructure. The third thing I'll give you, which is also a bit of a teaser, is what I'm referring to is deep AI integration. A year ago, we did an AI course, in-person training that some of you were at. And I'll say this a few times as we continue building. That was largely a swing and miss. And my observation in that was we were sort of guessing at what we thought it was going to look like. And maybe the tech wasn't there yet, or maybe even I didn't quite fully understand the opportunity of it. I think 12 to 18 months from now, the real estate teams and businesses who haven't fully built internal AI architecture, we're talking about operations, we're talking about marketing, we're talking about sales training, we're talking about listing and buyer admin, like all the stuff that lives in the back of the house of your business. The teams who've not done that over the next 12 to 18 months, this is not an exaggerant statement, I believe are going to get left in the dust. And the good news is I'm building this right now in the back end of Middleton Elite Coaching so that I can figure out what that looks like. And then we're going to case study it with a few of you. And then by the end of this calendar year, we're going to be ready to roll out both really purposeful, structured coaching and consulting about how to build it for yourself, and probably also be at a spot where we can help do some of the installation of it. We're not going to talk about all of that today other than to tease it, because next month, I'm going to do a webinar on this exact topic. I have a QR code for you at the end of this that you can scan to register for it. It's free also, and we'll record it. We'll send it out. You'll see a bunch of stuff from me. But the pieces that I'm going to begin talking about in this is the importance of building your own internal knowledge base, using your own coaching and training that you do with your teams, using your own scripts and your own words, using your own intellectual property that you've built over the years or decades, said a slightly different way. one of the big pieces is get all the stuff that you have in your brain out of your brain and into an AI version of your brain. For many people, it exists in their brain. It exists in like a Google Drive or a Dropbox or a whatever. It's this sort of like yard sale of information scattered all over the place. And I've been guilty of that as well. This is assimilating the yard sale into a spot that it is effectively an AI clone of everything that you've built across your career. I'm already building this right now, and it's super cool. Part number 2 is marketing collateral that actually sounds like you. Man, I get this question all the time. Is like, how can I leverage it to create my listing consults, my buyer consults, my Instagram posts, my this, that, my that, the other, but do it in a way that it doesn't sound like a 6th grader wrote it? Because that's most of what generically is going to come back to you from AI platforms. And perhaps you've experienced this. You give it some information, you ask it to write a listing description, and then your 14-year-old niece could have written it better than the thing that comes back to you. And then it's maddening because it takes too much time. So I'll teach you how to build something in the back end of your office that actually sounds like you, that starts to create brand voice consistent marketing material. And then part 3 of that, we're going to talk about like this relationship between the agent / team owner, the team members, whether that's salespeople or admin people, and the relationship with the client, and how all of that flows in a much more seamless way. And it's not this like disjointed, you go on a listing appointment. I'll be exaggerating for effect. You go on a listing appointment, scribble a whole bunch of notes on a legal pad, come back and drop it on your listing assistant's desk, do a 5-minute brain dump of how the appointment went, and then your photographer drops some photos in a Dropbox, and your listing assistant's trying to write a description about the house. And if you've ever done that, I'm not calling you out because we've all done it, but how we smooth out all of these different processes internal to your organization so that both you don't continue to pull your hair out, your staff doesn't continue to pull your hair out, you don't have to answer the same question 10 times, which I know is maddening because we all have to do it, but maybe not anymore. And ultimately that smoothness and efficiency that comes from it. None of this is theoretical to me now because I've spent the past 2 months building it internally, and it is the number 1 priority on my strategic plan is to build something that you can go implement in your business. So in that webinar that I'll do next month, May the 27th, here's a QR code for it as we get a Q&A. I'm going to give you a peek under the hood, and we're going to start building on that together. I think you're going to find it super exciting. You could probably just tell by my energy on this that I think it might be the biggest thing we've ever done collectively. With that being said, there's a few things on this slide I'll draw your attention to. The QR code to register for next month's webinar. If you choose to do that, would love to see you there. Even if you can't attend in person, you'll get the recording of it. I have linked in this slide deck, this little here thing links out to all of the resources, articles, and partridge in a pear tree that led to this presentation. And for those of you who aren't in coaching with us, if you're interested in doing so, you can learn more about the work that we do at Middleton Elite Coaching or contact me directly to chat about it further. With that being said, I'll leave this slide on the screen, but I'll bounce over and I'll check the chat box because we're right on track here. We've got about 10 minutes or so left. And I'm going to see what we have. If you have a question you'd like for me to address, either specifically from the presentation or if it's just some other real estate related question, feel free to drop it in the chat box and I'll grab it here while we have 10 minutes or so left. What you got? So I either did such a great job that you have no questions and are fully inspired to go set the world on fire, or you're all eating lunch with me operating in the background. I'm just picking at you. Thank you all for your time and attention. If I can do anything for you, please reach out to me. You can find all the work we do at middletonelitecoaching.com, and keep up the great work. We'll see you around.